cappuccino. I done made a song. Stack it up, stack it up.
Hey, good morning, good afternoon. Welcome back to the Pit on Thursdays. I'm your host today, RT, going by Random Task 555 on Twitter. And on my right, I have the man, the myth, the legend, Captain Rational. We're gonna call him Noah today, which we have permission to do. And then we've got Jewbacca, and we're here to talk about Ripple. Believe it or not, Ripple Day, and what it means for the broader crypto market, or what we think it might mean, because nobody really knows. But it's good news. Really good news dropped today. You guys can thank me. I stepped out of the office for an hour and a half, and then it happened. So that is not a coincidence, and I want full credit. How are you doing today, guys?
Doing well. Yeah. I mean, longed right before the news. So
Yeah. I did pick up a big bag of OP
you did too?
optimism this morning, just because the chart looked good. It was a setup, but it happened to get some fuel from this. It's up 13% today, so that's freaking awesome. But Solana bag not big enough, causing me a little bit of FOMO, being such a soul bro. Never big enough. But
I don't
really
know
want to
any
talk about.
soul. I just own Hxro and Bonk, which is always, I don't know.
Oh, your old Bonk. Nice. I haven't looked at Bonk
Yeah.
in a long time. How's it? It must be flying today.
It's not. Like I've been coping. Soul's been outperforming Bonk.
Bonk is a weird one, to be honest. It's
Yeah.
it's like exponentially bad when it's bad, and it's like pretty good when it's good. It's not
Mhm.
it's not found a bottom yet, according to the higher time frame.
Exactly.
I mean, I'm really here to talk about cash flow assets today. That's really been Noah's specialty over the last few years. I've been watching your streams when time allows, and the idea, like, risk-free positions that generate cash flow. I mean, what a dream. And like we were talking about it before the stream, so I feel like we got ahead of ourselves because we talked about some good stuff, but you were just saying, like, that kind of portfolio will underperform the capital gain portfolio where you're just like flipping shit coins and rotating. But it's like a slow and steady wins the race. For those of us, people maybe watching our stream from our community and that maybe not have seen your thing, do you want to just give your overall, like, high level thesis on sort of why you do what you do?
So you said underperform from a capital gains perspective, but on the other hand, it will significantly outperform from a work-life balance perspective.
Yes.
There's basically no work. It reduces to the complexity of finding entries and being picky. So it's just a different methodology for engaging with markets. And the most interesting thing is, as much as it will significantly underperform relative to capital gains, it's going to significantly outperform compared to the SPX and even NASDAQ by the tune of multiples, merely because of the way liquidity flows from market to market, and the relative size of markets and the potential delta in total liquidity in markets. So I expect significant outperformance for my relatively underperforming portfolio.
Yeah, well, I think you nailed it with the work-life balance thing. That is something that can't be taken for granted, especially for people who have kids, where you're kind of like, and I've just had a few, obviously, and so it's like I definitely don't want to turn into somebody who's like, oh, sorry, daddy's got to go work, and like miss their childhood to scrape out a few extra percent. So I'm really trying to reformat my trading plan to align with, like, swing trades, high time frame swing trades, which was my bread and butter before. But when there's no swing in the market, it's really hard to do. And then these cash flow plays, especially because staking, like master nodes in 2017
Mm.
and DeFi lending type stuff in 2021, 2020, like that shit gets really sexy at the highs, right? You get into those 4-year locks when everything's inflated and crazy and everyone's printing, and then it just, and then everyone's like, nah, I'm never locking again. I think this is probably the year, maybe even a bit of last year, but like this is the kind of year, this is the part of the cycle that probably staking and locking up some stuff for yield is back to like a good idea if you
Agreed.
pick the right ones, because it's not that sexy right now. It's certainly not overheated. And maybe in a year or two, it's going to be all the rage again. And then at that point, you can be kind of like de-risked and chilling.
I think you're spot on, and I think the reference to 2017 is quite meaningful. The equation was different, especially in 16-17 market, um, as compared to what started to emerge in 20 and 21. So I did not have this mentality nor methodology in 2021. It started to pique my interest in understanding the mechanics at play and to find the simile, the comparison to traditional financial uh, flows and systems to understand what was occurring and why was it occurring, and if it was actually significant, was it actually different this time. 2017 master nodes, yeah, that was interesting. There was
Dash.
nothing there, especially in hindsight,
Mhm.
understanding the systems we have today. Um, there was no there was no federations. There was no third parties consuming, uh, needing to consume for their own survival. There was no organization. There was no recirculation, regurgitation, third party capex deployment to finance sterilization. I know I'm throwing a lot of words out there, but the whole point, most important to understand, uh, is to not be turned off by what occurred in 16 and 17, but to merely understand that that was an entirely different regime. It was an experiment, and it was nothing like what's occurring now. What started to manifest in 20 and 21 really comes to full focus, especially at the end of 22, um, during depreciation. Anything that is increasing supply during a depreciative cycle, of course, it would do exactly what happened in 17, heading into 18, especially 19. They went to oblivion. They were diluted to oblivion. But that didn't occur in 2022. They were crushed, but they are some many assets and many protocols with the financial flows that manifested very much thrived in 2022 and were very productive from a cash flow perspective. 20 to 70% during 2022, sure, principal was depreciating. It's volatile. The market was volatile, but the
Mhm.
cash flows were there because the revenue was there, because the volume was there. And heading into 2023, everything becomes crystallized and solidified at this point.
And what's one of the names you liked in 2022? I hear you talk a lot about Frax. Is that sort of what you're talking about for like a productive protocol, like as an example, Curve, Frax?
Curve, Frax, Aura Balancer are the pinnacle of this phenomena. It started with Curve, and when Curve launched, nobody knew. I didn't know. We were in the DeFi summer, the incentive regime gauges and just dilution and ridiculous percentage APRs. We didn't know, and I didn't understand the comparisons to traditional finance, especially as compared to today. But those are the prime systems that have at least achieved what is required for that cyclical cash flow to actually work. Frax not necessarily right now, but Frax is just has its tentacles everywhere. And
Mhm.
if it matures into what has been laid out in vision, something fascinating is going to occur. I have a primary philosophy that's basically, I'm not interested in price appreciation. How much are you paying me? It's basically my pinned tweet. And then the business owner says, "Oh, but the asset's going to go up in price." And I'm like, "I don't care. Fuck you. Pay me. I'm not going to invest in your company unless you're going to pay me."
Mhm.
So, that narrative isn't really valid with Frax at this point. So it's very hard for me to override that criteria that I need for an investment. But something about Frax actually achieved that because just the scale and scope of what is possibly there, especially with FRX ETH as the ETH of Frax chain, and then that's just wild to even attempt to contemplate the scale and scope.
Yeah, I've been watching Frax again. I'm still in this price appreciation mode. And so some of these DeFi coins are not ideal because you have to read into them. Obviously, a lot of them turn out to be dilutive and farmy. But
Of
like you
course.
said, if you're staked and you're part of that dilution, then it's net positive. How do you deal with the swings in emotion that come from your underlying losing value? Because this is where I struggle. I'd get into something. Actually, I'm doing this with Lit right now. I decided to take a plunge this year. I put in a fat slug of Lit ETH LP for the VLit, and the principal on that is down 50%.
Indeed.
And I have not farmed nearly enough to make that worth it yet. The swings are crazy. And, emotionally, I'm using the lock, but I have no choice. It is what it is. But like when I do the math, I sit there and I just think it's so hard to predict if that principal depreciation will destroy any yields you might get. So like, how do you deal with that?
So it's not necessarily it's not dealing with, it is very hard to take positions. And the most important thing is to invalidate positions, and that has to do with the attributes of the system. The most important criteria for a functional gauge system is a growing federation of third parties that are financing their liquidity. So to be very clear, Bunny does not have a growing federation of recyclers and sterilizers. What are those two words? Recyclers are taking that they're removing circulating supply. Well, that's maybe more so applicable to sterilization. So that's going to obviously diminish the dilutive effect of the increase in circulating supply by the gauges. So the federation, what is a federation that I always talk about? It's third parties that are using these gauge systems to finance the liquidity depth of their protocol. So if a protocol wants to come online, back in 2020, we saw they would finance one-to-one. They would deploy a gauge or just throw their token, their own token, as incentive for liquidity. But when you're having a third party, for instance, Balancer or Curve, finance that liquidity, you're getting a multiple. So it's increasing the capital efficiency. So that's the business. That's the business model. It's catering to third-party actors that have an existential requirement to finance the liquidity depth of their protocol's asset. And that is why the Federation 1 existed, why it builds over time, because you can imagine heading into upcoming cycles, increasing liquidity conditions, 1, 2, 3, 4, 5, $10 trillion worth of liquidity in the system, new businesses, enterprises being conceived. It's nothing without a capacity to exchange their asset. And to do that, you need market makers. You need to finance the liquidity depth.
Yeah, Bunny's growing. I mean, their TVL is increasing. As far as I forget the word you used, but like taking supply off the market. I mean, the only real function of that is the lockup for VLit, which
You need the third party incentives. So the biggest third party that has shown interest in Bunny is Liquidity. And now they're taking an interest in Maverick. So Bunny's interesting. It has potential, particularly because it correlates to Uniswap, and Uniswap has the vast majority of volume on Ethereum mainnet.
yeah,
So I
that's
don't
why I
write
like it. That's
off,
why I went for it, and I felt early.
and it makes sense. It makes sense that you really need this type of liquidity financing regime bootstrapped or applied to the Uniswap system. It might not stick. It's still speculative in my mind,
Yeah.
particularly because to understand these systems and what you do as well from a capital gains perspective, you have to get into the psychology of the peers, of the market participants. So what is the demographic composition of Uniswap? It's not necessarily folks that are even providing LP. Those are more the predators or the active actors providing liquidity on Uniswap. The vast majority of people participating on Uniswap are just mom and pop that are like, oh shit, MetaMask, and oh, what could I do a little bit beyond MetaMask? Or maybe I'm swapping in MetaMask and it's all getting routed through Uniswap. So it's a very different type of market actor as compared to persons engaging with other protocols, other exchanges.
That's a good point. So like it's less about Aura and Balancer's relationship, and it's more like a retail mom and pop shop. I mean, there's some hope, and I'm not the bunny guy. Like there's a guy I work with, who I really rely on for like the latest on what's going on over there. But he's they're going multi-chain. They're going to be adding some new chains in, and hopefully we get somebody like Aura or like one of these larger conglomerates to come in and start accumulating VLit and let the lit wars. I mean, that's the ticket. That's the one we're looking for.
Correct.
In the meantime, we're using it to bootstrap liquidity for smaller projects that we work with and offering up, Gage's proposals and then voting in their pools. And so it does have utility for us too as a fund, but it has yet to really break through. Obviously, I think I've been super impressed with the team so far and the community and like the drive, to add things to grow. And it's still really young. It only launched in January. So I'm hopeful that it's this cycle's, big super fun DeFi play, but I'm a little biased. I'm one of the top VLit holders, and it'd be really cool if that didn't, if that aged well. But
I think you're spot on.
yeah, and at this point, I mean, obviously, because you've told me this before, we've talked about Curve before, and you're kind of like, yeah, just keep in mind, like I bought Curve at whatever, 25 cents or something. You're well de-risked. You're deep in the mud. You're collecting cash flow. At this point, where things are at, what are some opportunities you're seeing in the market? Maybe for some people watching today that are not yet into this stuff or don't know about it, and they're thinking about some protocols or looking to get their feet wet. Lit was my feet wet moment, learning gauges and how that works. What are you seeing today in the market with like fresh opportunities? Or maybe you're looking at Balancer like, it's still pretty good to, it's still not dead or too late or whatever.
So entries are the hardest with regard to this methodology. Essentially, the methodology is relatively simple and it's historic from a Buffett perspective. It's during strength of markets, you're accumulating cash. So in weak markets like right now, we've been accumulating cash in 2022. And for instance, my cash is denominated in like Ethereum and Bitcoin at this point. And as markets appreciate, that gets converted to stable coins and whatnot. And then the goal is to have a cash pile. And then when markets tank, then you're able to acquire hostile takeover cash flow productive systems that are positioned to survive. So, and that's what he did for decades. You could have.
So during this rally, have you been basically stacking a pile of stables ready for, potential Q3, Q4 dip to start allocating again, or what's generally been your strategy there?
Well, I was consuming. I was structuring capital management and optimal tax treatment, which we talked about obviously over time, and so I did not have the intention of accumulating all capital for purposes of investment. But relative to 2019, the amount of capital I had in the space, I have the exact same amount of liquid capital available. If and only if an opportunity that really ticks all my boxes presents itself. And at this point, I see nothing. And that's really what I was hoping for in the next cycle, as compared to what I said in my choice in 2022, is that I won't have much to do. And there's nothing that's screaming, I need to deploy anything. I have these assets that are going to underperform from a capital gains perspective. But if I get a 5x from a portfolio perspective or a 10x from a portfolio perspective, and then the equation would be, since how the financing occurs, that's denominated in Curve, that's denominated in BAL, that's denominated in Aura, the APR jumps to 1,000%, and then it gets diluted back down to 20%. So overall, that sequence of events is your portfolio goes up 10x and you're making 20% of the money.
Yeah. That's not a bad way to spend a cycle, especially if most of your days are just spent casually watching everything here and there, because like you said, you're going to miss the pump. Like there's going to be a hot money, hot ball of money cycle through AI again or LSDs. And you're going to have to sit there and be like, yeah, well, that's cool. Could have had 50X there. But like you said, like 2 years later, you've just been clicking claim. And so, and if you can squeeze out a 10X, that's, from many perspectives, that's an absurd return over
Indeed.
2 years, and then 20% on top. I like it. Yeah, this is an area that I want to learn more about, especially now having the twins and having 3 kids. Like I'm just not suited for the kind of trading I was even 2 months ago. I've noticed that I'm too tired. I'm distracted. I come in with a half vision of things and catch a move a little late. Like it's not been going great. Thankfully, I'm a risk manager, so I haven't really lost much, but I've missed a lot. Like even in my own
Yep.
trades, just missing trades, missing the meat of a trade. So it just drives me nuts. It drives me more nuts almost to miss things than to like not have been in it. So I'm transitioning more into like picking up some of these reload zones, flipping for a free position, and then staking or printing. I've got what's some of the ones like GND. Have you looked at GND at all? It's built on top of GMX.
That's interesting. If they have a consumer, I mean,
Yeah,
GMX.
yeah.
Oh wow, look at that.
They do
Pretty.
something with the GLP yield, something more than
Oh,
base yield, and so there was one of our analysts actually has been on the stream before, Smeety Boop. They had written a report actually just before this thing took off. We missed it, but um, that based on the APRs and all this and that, it should be worth X, and it was well below. So this one I've been watching. I have a small bit locked up, and it's generating some ETH yield. So this is one that's on my radar. And there's a few other new ones. I mean, there's a whole little ecosystem here. GMD, like GM is in Mary, is another one.
so
It's a
where does
little
the cash flow come from? This is trading. This is a perp exchange, or at least a derivative of a perp exchange. So derivatives are a way to encapsulate cash flow into something that is a simplified way of surfacing that revenue, either be appreciation or a dividend, the traditional terminology. So this is why Arthur Hayes did what he did with GMX, and why he owns what he owns, because that's his background, that's his history, that's his comfort zone. And literally, he bought an exchange, and he doesn't care about the price of GMX. I'm sure the odds are it's probably all locked, and he just expects it to go 100% TVL and 100,000x volume, and he's just going to be printing
Yeah.
cash flow all over the place.
Yeah, he's been very vocal about his GMX position. So I won't even bother getting into this because I can't. Like GND, GMD are just a couple on my cash flowy type radar, like yield plays. Exactly what they do to the GLP and how they make it print more. Because my first question was kind of like, well, why would I grab GND and stake it when I could grab GLP and like just go right to the source? So they're doing something that makes it cooler. But then of course you get the risk. Um, you get the risk that comes with every smart
Of
contract
course.
layer in between.
Yeah. So Noah,
Yeah.
do you not have any exposure to like DEX value accrual staking tokens, exchange fee type cash flow assets?
Indeed. I no, I got marginal scraps on like optimism from like synthetics and
Mhm.
fails. I mean, Hero. I mean,
Yeah.
isn't that's
Yeah.
where's that
That
cash
is
flow going?
the value accrual token that we're working on. I mean, look, to be fair, nobody on this stream is directly working on Hero or Hero Network. We are simply creating content through a sister company, Hxro Labs. But yeah, value accrual.
Isn't it?
That's kind of where I was going to take this conversation. Is like everything you mentioned is built on Ethereum. And I talked about this recently. Like I find the yield stuff over there, especially Bunny, it's very gas intensive. There's like,
Indeed.
for your VLIT, you gotta have 6 or 7 or 8 different LP positions, and as they grow and shrink, your boost goes in up and down, and then eventually you want to rebalance. And it's about $800 in gas every time you want to touch every one of those.
Pretty
So
much.
which I try to do very few. So like
Mhm.
30% of my yield is gone to gas. And that's one of the reasons I think something like Solana built DeFi, can they do all of the business activity that's taking place in Ethereum and just do it more efficiently? Are we going to see a swing like that? Is it less of a leaving Ethereum and going to Solana and more of a just general growth and liquidity in the market in general? And then, yeah, things like Hero Network, PepperDex launched recently. They've got a lot of value accrual type tokenomics, which will be stacked on top of the Hero staking. So there's some really cool shit happening over there. Are you watching Solana Eco at all?
Well, PepperDex. That's probably the only thing that has come to mind. So my entire strategy right now is in validating things that I could even potentially consider. The hardest thing, especially with inversely proportional to the size of a portfolio, the smaller it is, the harder it is. You must invalidate. If you cannot have an adequate position size, unfortunately, it doesn't validate taking a position. Because smaller portfolios need to be much more concentrated, and you can't afford the diversification, can't afford the protection, which does relegate, unfortunately, the smallest of portfolios to capital gains methodology. It just is not productive enough for using this as we discuss.
Like 20% a year on $10,000 is not going to pay the bills, is essentially what you're saying.
It's not going to
Yeah.
pay the bills,
Yeah.
but obviously, like I spent 2022, spending and not really investing, or not really accumulating with the intent to invest. There is the concept of compounding, which is interesting. It's fortunately, it's something I don't have to consider. But what does the traditional dividend investor from a TradFi perspective talk about all the time? It's literally just compounding. The complexity is, let's pick a dividend bearing stock like a Walmart that has cash flow. It's basically zero interest. You're not going to be able to compound crap unless you have like $20 million worth of it. And then what's the potential for the cash flow of the business to go 10x, 100x on the money? Walmart's not going to get 10x, 100x on their cash flow. And if it goes to 10x, 100x, their dividend isn't going to go 10x, 100x, causing capital inflow to dilute the cash flow. So none of these equations and the potential in the crypto markets exist in traditional finance anymore. There's no asymmetric growth potential for cash flow. So these markets are just so fascinating, especially from a liquidity perspective and a friction elimination perspective.
Yeah, and that's exactly why I'm so gung-ho on the Solana Eco. Solana
Indeed.
mooning is great. It's step one, right? And Solana becoming cool again is great. It's step one. Like I can already see from the rally we've had even just in the last month off the lows. There's just like a new buzz about Solana, right? And there's just going to be new pitch decks, and everyone's like, "Oh, I'm going to build there," because that's where the excitement is. And the TVL over there, the liquidity on chain is actually still very poor. It actually reminds me of AVAX before Joe went and 100x. You remember like that August, pre Wonderland,
Oh yeah.
like right around that market cycle peak hype, and AVAX was just like a dead zone. And then all of a sudden they announced their ecosystem fund, and Joe became cool, but before that, just before that, everything was on there. Like Joe was sitting there for 30 days doing nothing, and there was no liquidity. And so when I look at Solana now, and you mentioned friction, then I see bridges popping up that are suddenly USDC native, much easier to deal with. It's all
Discord
becoming
bridges.
yeah, like the pieces are moving into place. I feel like there's a move setting up there for the ecosystem. And obviously I'm biased in that I'm super bullish on what Hero's doing with liquidity and stuff. So I'd love it if that rolls. But I'm looking over there. I'm looking closely at everything I can find. Marinade is their LSD solution that seems to have the most action for now. There's a few others.
There's two things that come to mind.
Orca.
Speculative yield, the potential, something that is not incredibly productive in its current form. And that has Hero written all over it. That has newly launched things like a bunny. The potential is there. That has like concepts of PepperDex and things that have the potential to emerge into a cash flow productive regime. And then there's the historic equation. I deploy X amount of capital and I will get X amount of APR. And what is the likelihood of that cash flow continuing into the future and growing upward? And
Mhm.
that applies. That is what I've talked about recently. That is the common denominator of all assets, including real estate, including buying a company. If you buy $1 million house that produces $100,000 a year in rental income, you bought 10% APR. So we have the calculation is we are purchasing an APR and what is the likelihood, and that's the speculation component of that APR continuing into the future.
Sorry, I got distracted by an ETH alert there at the last second, but yeah, no, I mean, I get it, and I think what I'm hearing is that, like, as far as things like Solana, you're more, because you're looking to go long term, you're looking to lock up. You're not necessarily looking to make exotic bets on new protocols that haven't yet proven their staying power.
I can.
It's like, how willing are you to give up that early high risk, high reward beta to wait for like the confirmation, like, hey, this thing's going to be around. There's enough large players that have locked, that have, moved into place. There's users flowing in. Like, where do you draw the line with being early and being right?
Spot on. And that has to do, portfolio size is a critical consideration. The smaller portfolios have to be more concentrated. I've have the luxury to be a bit more diversified and take on some spec plays. So right now, overall, probably my bunny position size was the same as my hero position size. And those are the specs. I mean, Hxro has all the writing on the wall as a network of networks that benefits from all the consumers. It's not really a federation that, as we've talked about with regard to currency producers, as I define like a balancer and a curve at the base layer. But it's a service provider, a liquidity service provider. So that's quite extraordinary. Frax, I've took that on relatively early, not necessarily in my current mental framework, but that kind of fits that criteria as well.
Mm-hmm.
It's not cash flow productive, but it's in that spec cash flow category, and bunny. So those are the spec growth. If they emerge into something great, if they don't, it is what it is. You have to speculate to potentially catch that early bit. Otherwise, what's that critical mass? I mean, Aura, not even Aura, it's really Balancer because that's the cash flow producer. Aura, Balancer, and Curve are critical mass from this observation, for this comparison to what the U.S. did in 1971 with oil for gas and the bond sterilization regime in Saudi Arabia that spread throughout the world, and everyone joined the federation to consume excess supply from the market, to sterilize excess supply, and that is what has occurred for these two DeFi centric currency producers. Look at all the derivatives, all these curve derivatives. It started with convex, and what happened with convex? Convex came online, and the hyperinflationary cascade of curve stopped. That's what bottomed curve and started the appreciation cycle, aside from just general FOMO and market activity. But as more and more consumers have come online, they have sucked circulating supply into permanent locks. That's not circulating supply. So that those increases in supply, those dilutive pressures have been sterilized. And by my count, there's 4 new sterilizers that will come online in probably the coming year, give or take. And the same is the case for the Aura Balancer Federation. It's all like liquidity loves. They need it. For a stable coin to work, you need these cyclical incentive regimes where, look what Frax does, and what liquidity probably wants to do if they don't do it to a great degree already. They need a critical mass of protocol and liquidity. And it really comes into how stable coins need to function to be protective and to not experience what Luna experienced. With adequate protocol owned liquidity, 100% of circulating Frax can be sold, and Frax has enough ownership of the LP to maintain the peg. So that is critical mass stablecoin, and that means with that protocol and liquidity, that's protocol revenue, which they can then recycle to incentivize liquidity depth, which increases their capital efficiency of that capex. So you
Frax
see
is
these
doing a great job
cycles.
of that. Yeah, Frax liquidity is impressive. Always when I look at it, 38 million, 13 million, like they've got deep pools. So they're doing very good at that. I mean, the chart looks fantastic. I had this, big fat falling wedge on it since last month and was looking at it here and flip flopped in and out of position once. But like, if you just look back here, again, you're saying it's not really a cash flow asset, but if it's got a strong network, if it's got staying power, which I think this one does, then this is the kind of chart that just screams, invest in me. Which is it's not advice coming from me. You should never take advice from somebody on YouTube. But when I look at this, according to my trading plan, like you see the buy volume rising up at the lows. You see it in these higher time frame reload zones. That's this colored area on the chart. That's what I call an investable level, an area where I think that there's better risk reward profile. So Frax is on my list for sure, but not as much for like, hey, let's lock it up, let's do whatever whatever you can do with it. I'm not actually that familiar with the protocol, but for the cap gains, for the buy low, sell high coin, this is one that I really like.
Well, that's the
But
equation too for cash flow is you want to buy something that is speculated. Frax is in this category, so is Bunny and Hxro. You want to buy something that you speculate to produce cash flow in the future, going up, that has the likelihood to continue to exist into the future. Therefore, it will be exposed to increasing liquidity conditions in the future. And you want to buy it as cheap as possible. So that's the speculative equation. And then the harder part of the equation, especially for newer participants in investing, is position sizing and the requirement to, depending on the portfolio size, to either be highly concentrated or if someone has enough capital to have the luxury to be diversified.
Yeah. Yeah. I mean, you nailed it. The position sizing is the hard part. Cause if you look, if I put $1,000 into Frax right now, I could just not look at it for 3 years. I won't care what the price is. If I put 90% of my portfolio into it right now, like it's going to be stressful, and I'm probably going to sell a dip, even if it's a dip that's a little higher than right here. Position sizing, very underrated decision in the market, and it's very hard because the psychology of markets, why traders lose most of the time. You size up your positions at the worst times, and you downsize them at the worst times. And so that's a big part of my new plan, which is just like having consistent and manageable position sizes such that they're the right mix of like exciting and sweaty. You don't want them to be too exciting and too sweaty. You don't want them to not be exciting or sweaty at all. You got to just find that balance where you're like, hey, shit, we're making money today, but on the down days or the flat days, you're not really caring.
And these scalings or these size assessments are so critical in making choices, and it's hard, meaning everyone has to come to these learnings at their own pace. For instance, cash flow. This goes back to like general capital management skills, which obviously isn't taught in institutional education. But if you're making $100,000 a year, whether it's by work or cash flow, how much is used for consumption versus how much is invested versus how much is set on the sidelines for potential investment at a more opportune time. And then nowadays, a critical equation is what is the denomination of cash? Because right now, the denomination of cash screams not dollars, especially looking at the DXY at 99.
Yeah, look at
Damn,
that.
839. This
Dumb.
this is what I love nowadays. I love looking at macro to find comfort. Comfort with the structure and choices from a hindsight that I made from a hindsight perspective, and to get a sense of directionality. Because if everything is expected to appreciate, my cash position need not be denominated in cash. But if you see liquidity start to drain from the system, which this chart is incredibly meaningful in that regard, then you change the denomination back to cash. This chart talks about international liquidity conditions. So that's the power of Forex markets.
Yeah, no, that's kind of what I was getting at before is like, what are you looking on a macro scale for in terms of, moving back to denominating in cash, potentially, over the next few months? What sort of conditions?
Months.
Yeah,
You
I don't
mean
know about
years?
so time frames. I have adjusted my time frame perspective predominantly to the 6 month. I
Mhm.
like to look at the short term because today is today, but predominantly the 6 month is the most meaningful, especially from SMAs, EMAs, and trends. It's all about directionality because in nature things are going up or down, things are left or right, things are 0 or 1 binary. The entire system of the world reduces to 2: Republicans, Democrats, team A, team B. So nothing is constant. Weight, humans weight. No one's the same weight tomorrow. You literally fluctuating based on water weight. And so the point is everything is either up or down. And for how long? And that's what these charts scream from the larger time frames, either up or down for periods of time. So this chart is just beautiful from an increasing international liquidity conditions perspective. If you want to see my perspective, hit the 6 month on this beauty.
Yeah, you know what? I was actually thinking today, I'd like to see if you want to do a screen share. I don't know if you have your charts. I just know your global liquidity chart is like with the guppy on it. It's one that I really like seeing on your streams. It might be a great one to share today for
I
this
don't
part of the
have,
conversation
yeah, I could
if
pull
you're
it up.
ready.
I don't have G7. I mean, that's just like M2, but this, that's just like, that's part of the equation. It's really this chart. But I could share mine.
Yeah, if you don't mind, I think I just have to take mine off. I'm sure people would appreciate seeing exactly what you're talking about. I don't have those kinds of charts here. I'll take my
Yeah,
screen
but the
share off.
TLDR is that it would take a while for you to see, for you to essentially bet on a reversal, or you would need to see that happen from, at least a 6 month time frame.
Like,
Yes,
yeah.
but it's not about, well, you already saw the reversal. Yeah, do you happen to see the chart?
Our producer's just plugging you in. I see it on the little side chat we have.
Okay. So this is the 6 month. So from a guppy's perspective, it obviously a chart indicator. It's not too significant from a 6 month perspective. Obviously, a breach of guppies to the downside. So that's a congestion of moving averages. So that's a support threshold that, and look at the compression of the guppy. So that stands out to me. The time weighted average price, which is the red turned green multicolor line, that's a support line as well from an average time frame perspective. This is a lot of my perspective on also chart indicators. Love moving averages, and especially breaches of critical moving averages to indicate significant directionality change. So what screams to me in this chart? The largest shooting star at a peak since 1985, with 3 cyclical peaks, of which we just experienced a third, potentially. So what we look for is confluence, uh, suggesting continuation of directionality. So clearly, the shooting star reversal indicator, second candle closing below both the open and the close of the shooting star, and to top it off, a third, significantly below even the wick on the follow-up candle. So this chart does require that kind of time horizon, meaning we check back at the end of 2023, heading into 2024. So if we have a close on this current candle below the close of the most previous candle, that is a second candle of confluence supporting the directionality reversal indicated by a classical shooting star. And that's extraordinary from this time frame perspective, particularly because we've been in a dollar bull market since 2008. So we've had our cycles. And maybe if we zoom in a little bit. So interestingly enough, I'll just draw it real quick. Brush. Boop. Boop. Those time frames are quite compressed on this high time frame chart. That's everything that we've ever done with crypto markets in two circles. That's the bull market.
Yeah.
So imagine, but those bull
Talk
markets
dirty.
in crypto were only micro cyclicalities or literally just volatility events in an overall bullish trajectory of the dollar. We haven't had a cyclically bear dollar market since it peaked in 2001.com.
Super cycle talk.
Well,
It
seriously
is.
though,
It is, yeah.
I've got those vibes. With the kind of institutional onboarding we're seeing, Ripple today, and this kind of a nice tie into Ripple being deemed not a security as a precedent setting case is going to be something that Coinbase and some others can point to now, whether that's library credits, I don't know. But like, if you see those kinds of headwinds moving out to the side and you see institutional money coming in, regulated money coming in, then anything we've had to this point is going to be a peanut by comparison. We're still
Playing in the
smaller than,
Right on.
sandbox.
we're still smaller than one stock in one country. And mind you, it's the biggest one or one of them. But even looking at the NASDAQ boom in 2001 was something like 7 trillion peak. And we peaked at like 3. So yeah, as much as I am in disbelief, and it's hard in this part of the cycle to get super excited about new all-time highs now. But like, yeah, if you told me there's a much larger sustained move in this entire ecosystem or entire sector coming over the next period of 7 years, I would be saying, yes, that's why I'm still here.
I think it's beyond that.
I apologize, guys. I have
Talk
to
dirty
bounce.
to me.
But yeah, it was great meeting you on stream, Noah. I'll definitely tune in to your stream to hear more about cash flow assets and how you're thinking.
You got a cut?
More... Yep. Yeah.
Okay.
I got a cut. So.
All right, man. Get back
Cool.
to work. Don't look
Yep.
at the charts.
Yeah,
Talk to you
appreciate
soon,
it.
brother.
That's...
Cheers.
I go as
Hold on a
long as
second.
you want.
Before he said that, you said something. You said, I think it's bigger than that. I just put on my max bull thesis idea. Like talk dirty to me. What do you got? How big?
Well, I don't think in terms of targets. I think in terms of directionality, and I think in terms of deltas and liquidity, and I think in terms, honestly, V equals IR, which is a classical current flow equation from electrical engineering. So voltage is a delta in liquidity. So if you have the United States with $1 trillion and Europe with 100 billion, and all of a sudden some incredible investment opportunity presents itself in Europe, you could have the potential for significant cash flow from the United States to Europe because there's excess liquidity here and an incredible opportunity over there that does not have enough local liquidity. So what would inhibit that potential cash flow, which would be current in the classical uh, physics equation? Resistance, frictions. So the current, the cash flow, is inversely proportional to resistance. I equals V divided by R. So as resistance and frictions are eliminated, that increases the potential for liquidity flows significantly, frankly, inversely proportional. So that is profound from a traditional financial perspective, because traditional finance is riddled with frictions, and it's frictions they don't even know they have. So that will take time for many actors to realize, and there's also legislative and regulatory frictions, but frictions such as underwriting, where it takes X amount of time for subjective human expression of risk exposure to a lender by a debtor. And that entire equation changes with regard to these systems. There is almost a risk-free presentation when a lender especially is over collateralized and you have uh, sociopathic liquidation algorithms that aren't negotiable with. There's no court, there's no special contract for a special client. If you're
You just got to check
capital,
the chain.
yeah,
Yeah.
and the debtor's liquidated. It's done. There's no ifs, ands, or buts. The protocol is protected. So this changes the equation from a traditional financial perspective, where lenders take on significant risk, obviously under collateralization, but also special contracts depending on the client. And that's why banks are in trouble. Could you imagine if HTM portfolios of banks instantaneously liquidated depending on actual mark-to-market valuations? It's just
It'd be problematic for the bonds markets, from my understanding, with the rate changes. But I'll be honest with you, I am learning and writing things down as you speak. I don't actually have a background in this stuff, so it's not really my bread and butter. But one of the issues with the bank collapses was the bond rates changing, right? So they had a ton of these bonds on the books. They got repriced. They couldn't meet their obligations, and they collapsed or got bailed out.
Of course. So they have $1 trillion worth of obligations, or that'd be a big bank, like $100 billion worth of obligations, and they bought 100 billion. So they had $100 billion worth of deposits. They bought $100 billion worth of bonds, and the bonds depreciated 20%. So now they have $80 million worth of potential liquidatable value in their portfolio and $100 billion worth of obligations. But what if that portfolio was liquidated in real time? That screams everything that we're doing. You sell the bond the second your portfolio is worth less than $100 billion to maintain
Automatically, yeah.
instantaneously. So there goes the frictions.
Well, and that's kind of the gross thing about banks, and it's pissed me off for a long time. Even before I got into crypto, I just was looking at it like this fractional reserve thing. This idea of like, we're going to maintain 10% because depositors aren't going to all withdraw at once. They can't all withdraw at once in that system. And then you look at, when was it? A couple years ago, the U.S. actually got rid of the 10%. They're like, actually 0% is more appropriate. Like, there's just no requirements. And so when you get a bank run like SV Bank, just
That's right.
disappears and you lose money. So I think the world is wisening up to that. And so when you talk about like bigger, you're seeing an entire systemic shift towards this potentially.
To a degree. That's the scale and scope of the speculation that I find quite interesting, because obviously from a valuation, capital gains, investment, speculation perspective, from that alone, we expect capital inflow. 3 trill at the last top, 5-10 trill from just a price action speculation standpoint. But what about credit and it actually being needed by enterprise to handle OpEx, operational expenses and capital expenses, and something they rely on, like it's called net 30, net 90, which is payment terms. So banks extend this short-term credit, so corporations and small businesses can actually operate considering those payment terms. But if a bank isn't able to lend because they don't have balance sheet capacity, companies might, it's existential. If a company's going to go under, if they don't acquire credit, they're going to try and find a place where credit is offered. So we're not there yet because we still have a great deal of friction, but there is it's permissionless credit. If you post an RWA, which is a narrative that's growing, real world assets,
Yeah.
Ondo Finance and on-chain treasuries, and that's probably the most known one. You have a capacity to acquire liquidity to finance your operations for purposes of remaining in existence. So it might be outside their comfort zone, but it'll keep them alive.
Yeah, you actually just answered a question that popped up in my head. Like with banks, you can go in, no collateral, and get a loan based on your credit score, based on your company's previous revenues, whatever. And in this new system where you're talking about like, no, it's the collateral behind it. And then if you go below that, you just get liquidated. It, but with real world assets, potentially you could borrow when you don't have the capital because you have some kind of asset that you can tie to a blockchain, to a smart contract. And that's going to happen. I mean, obviously, you want to be able to have a system where you can lend out money to someone who doesn't necessarily have collateral, but they have a good name, they have a good history. That I don't see that going away. You know,
True.
banks are good at that, giving out money that the person does not necessarily have because they like collecting. They're like, if you don't pay us back, credit score is ruined. We'll take your house, and you'll pay a lot of interest, which we like.
It's their cash flow.
But if the avalanche slides too deep, then obviously you get 2008. So it's a risky system. From that perspective, and we're getting just over the top of the hour. Like, what do you think your your number one use case for crypto is over the next 10 years? Since we're talking about high time frames, like
It's
use
not
case
what
beyond speculation, which is where we're at right now mostly.
certainly not what most think. I'm quite interested in the
Well,
credit
that's
angle.
intriguing. Yeah, hit me up.
Credit primarily, and which has a story to be told in the context of printing dollars. So, and this goes into like the historic Eurodollar system and how the world operates from a liquidity perspective, who prints the liquidity. And obviously, this is very counter or conflicting with like the Bitcoin narrative in regards because it's consistent with the status quo system. How does the status quo system work? And then how long can it continue to work are topics of conversation. And I'm not the one to really lean to post-apocalyptic prepping with regard to like the narrative. All right, what happens if Bitcoin is the only thing left with value and there is nothing else? Because what kind of time horizon is involved in that, and what kind of other requirements like war and famine and
Mhm.
social civil unrest. So, I appreciate that narrative that is often offered by that community.
The lifeboat narrative. Get in now
It's
before the ship sinks. Yeah.
But in that type of scenario, I kind of really want MREs and guns and ammo and maybe a farm in the backyard, probably a little bit more. So it's complicated. So in the
Yeah.
meantime, while the status quo system continues to exist, what I want is cash flow based on a capacity to print dollars, which is not primarily the result of US Treasury or policymakers. The vast majority of dollars on the planet that are used even by you and I are printed by banks, and even more so printed not in the United States. There are significantly more dollar liabilities than actual dollars, 100,000 times more. It's
I
extraordinary.
read something about that yesterday. Yeah. A little concerning. Mildly concerning.
It's
I don't know how the
leverage.
guys at the Fed sleep at night.
Well, the whole
Can you
system is
imagine?
leveraged, and they
Yeah.
manage it by their regulation of the banking and their reserve requirement. So by decreasing reserve requirement, that increases the capacity for a bank to increase currency and circulation. And it's the same equation across the world. So what's interesting is the dollar, DXY, or at least what the
Yeah.
DXY kind of generalizes. It generalizes international geopolitical collusion because we're
Hmm.
in a managed liquidity environment. They raised rates to execute domestic policy. They pissed off the world. They do this cyclically. Now what they're doing is they're flooding the market with collateral. What do you do with collateral? You print dollars. And if the US has been in a bull market, dollar bull market since 2008, 15 years, ooh, they've pissed off people for a long time. In fact, this is the longest run on the DXY. So it would make
Yeah.
sense from a political perspective to, all right, let's work with public and private sector to depreciate the dollar and give the rest of the world a liquidity break. Because if the dollar depreciates, foreign currencies appreciate, which gives them more purchasing power. And now the world is flooded with liquidity. So that's why the DXY down is a decent proxy for international liquidity conditions. There's the buying power.
Bullish things, in other words.
Dollar down and move, MOVE, down is two of the most bullish directionalities we could have.
So on a scale of 1 to 10, we're going to wrap up the show today. Appreciate you guys coming to watch. And if you haven't, hit the sub, hit the like, all the good stuff. But on a scale of 1 to 10, because the face you just made kind of got me fired up. How excited are you to see the Dixie breaking below 100? Like, I know this, you're watching 6-month time charts, time frames. So like when you see something like that break really at the open of the 6 month, right? Just what, 30 days ago. Um, is it fair to say we're off to the races? Like on a high time frame, not
Uh,
necessarily like this afternoon. Obviously today we're moving, but
yeah, my time
your feeling.
frame, I offer folks listening, and obviously I talk about this on my stream. I need to see the end of 2023. Starting 2024, that the next candle, one candle, 6 months, then that's confluence. It's confluence of directionality continuation. We have the TWAP on the 6 month down at 97. So January 2024, if we're below 97,365, below the TWAP, if you look at this chart, when the 6 month breaches that TWAP to the downside, there are years of continued dollar depreciation. That's not a 2013, 14, 16, 17 market. That is the super cycle thesis with regard to how it's expressed in terms of asset price appreciation. We're talking half a decade of dollar depreciation relative to foreign currencies.
Yeah. It gets exciting. I mean, I've had January circled on my calendar for different reasons. Well, similar reasons. It's been historically the best month of the year to deploy capital, coming out of tax selling season, and having never fully capitalized on it. This year I did. After FTX, I nuked everything into cash and I moved it. And then like January 6th, I looked around. I was like, okay, I'm buying things. So I deployed pretty heavily, and I think my next major deployment will be in January 2024. But maybe around that time we should talk, we should chat and connect, and I'm going to keep an eye on that level on the DXY. Actually, what did you say that number was? I'm going to put it on the chart.
97,365.
Okay, I'm going to keep an eye on that. I'm going to set an alert. 97,365. Because I love, the high time frame stuff obviously fuels the best trades on every time frame below it. So, and I've never gone as high as 6 months. But what you're saying here makes a lot of sense. And from that perspective, like you pointed out today, that the last two crypto bull markets, quote unquote, were really just these like down moves in a larger uptrend. And what you're seeing is potentially a shift of that entire higher time frame trend, which would very much be fuel for something like a super cycle. So
2018, when we peaked in 2018, that was the DXY hitting the 6 month TWAP.
yeah. So we've been bouncing up that for the last 8 to 10 years or whatever.
2020, their flooding of the market broke the TWAP, but then they tightened the hell out of everything. And when you tighten rates, that's bullish dollar. That's what caused this most previous pushback above the TWAP. But generally speaking, this trend has rolling top written on it. And that's even better expressed from the bond market's perspective with regard to bond market volatility, rolling tops. 6 months, 1 year, we'll have more confirmation the middle of next year. But this could be a very interesting, 3, 4, 5, 7 years, maybe approaching a decade.
Sick. Dude, love it. Absolutely love the viewpoint. It's very easy to get lost in lower time frames, and that's something I'm moving away from after having a few kids. So I'm super vibing with your 6-month chart right now. I'm gonna take another look at that and pull a TWAP up and just get some alerts going for fun. But appreciate you coming on today, dude, and thank you so much for your time spent and all that. And let's talk again soon.
I appreciate you as well. Good stuff.
All right. Take care, brother.
Cheers.
Cheers.
I'm up too nigga, this best up to Chico. Who got me frozen and so better leave on. I swap it for time and that's take it for me. Mo jittery base in 3 days, I'm on 3, I'm gone. Find me no control. Cappuccino to tone.